Hello, I'm Haida Malik, host of the Mehmi Financial Group podcast. Today's topic is thriving in lean times, using financing to grow during economic downturns. Recessions test cash flow and credit access, but they also create opportunities for expansion at reduced costs. Here's how to leverage financing strategically when the economy cools. In 1. Secure flexible liquidity. Revolve with an ELOC. An equipment line of credit lets you pledge existing assets or receivables to draw as needed. Interest applies only to what you use, making it ideal for covering payroll, vendor deposits, or shortfalls without committing to fixed amortization. Invoice factoring. Convert slow-paying receivables into immediate cash. Advance rates of 80 to 90% release working capital within 24 to 48 hours, freeing you to invest in marketing or take advantage of vendor discounts. 2. Lock in low rates on term loans. Fixed rate advantage. Central banks often cut rates during downturns. Lock a long-term fixed rate loan for equipment or expansion now to avoid future rate volatility. Even if spreads widen slightly, your cost over 5 to 7 years can be lower than floating alternatives. Bridge to fixed. Use a short-term credit facility to fund immediate needs, then refinance into a fixed-rate loan once rates stabilize at historic lows. 3. Leverage vendor and OEM programs. Promotional financing. Manufacturers frequently introduce 0% or deferred payment programs to sustain order flow. Seize these deals for machinery, vehicles, or technology upgrades at minimal financing cost. Model the post-promo rate and compare to your ELOC or term loans to confirm net savings. Bundled service contracts. Negotiate maintenance and parts coverage into your lease or purchase agreement. In downturns, suppliers are more willing to sweeten terms to lock in future service revenue. 4. Accelerate growth via sale leasebacks. Monetize equity. If you own late model assets outright, a sale leaseback injects 70 to 90% of an asset's value as cash. Use proceeds to fund expansion, new locations, fleet additions, or strategic acquisitions, while leasing back the equipment you need. Or balance sheet relief. Operating leases shift residual value risk off your books, improving debt ratios and capacity to borrow for other growth initiatives. 5. Tap government and industry funds. Stimulus loans and guarantees. Many governments offer subsidized lending or guarantee programs for SMEs during recessions. These can lower lender risk, translate into better rates, or reduce collateral requirements. Sector-specific grants. Look for grants targeting technology adoption, energy efficiency, or export development. Even in downturns, many provinces maintain support programs to spur innovation. 6. Strategic timing and discipline. CapEx versus OpEx balance. Prioritize investments that yield quick wins, projects that generate immediate cost savings or revenue streams. Delay non-critical purchases until the recovery phase. Scenario modeling. Stress test your cash flow projections under 10 to 30% revenue declines. Ensure any new financing leaves you with at least a 1.25x debt service coverage ratio under worst-case scenarios. B. Key. Maintain covenant compliance. Monitor loan-to-value and liquidity covenants monthly. Engage lenders early if you foresee a breach to negotiate waivers or covenant adjustments before crises emerge. 3 action steps. 1. assess, and audit. Compile your asset schedules, receivables aging, and upcoming capex needs. Identify financeable assets and receivable pools. 2. Solicit proposals. Approach banks, credit unions, and specialty financiers for ELOCs, term loans, and sale leaseback offers. Include OEM and vendor financing programs in your comparison. 3. Model and decide. Build a total cost of capital analysis for each option: interest, fees, maintenance, and residual value risk under recessionary cash flow scenarios. Select structures that maximize liquidity, minimize cost, and preserve growth flexibility. Economic downturns slow many, but they also open doors: low rates, vendor incentives, and distressed asset values. With the right mix of flexible credit, term loans, sale leasebacks, and government support, you can maintain operations, pursue opportunistic growth, and emerge stronger when recovery begins. I'm Haider Malik. Thanks for listening, and here's to thriving in lean times.